Hey, Derek, Merry Christmas. It's been a while since we've done a podcast here.
Due to technical difficulties. But yes, Merry Christmas to you. How was your Christmas?
It was awesome. A little bit, it was freezing, obviously. Because of that, it was a little bit low key, which actually is right up my alley. A lot of time with the family in front of the fire, opening presents, just enjoying each other's company. Sure beats traveling, in my opinion.
Yeah, for sure. We did like a Zoom Christmas, or not Zoom, but it was like Snapchat video Christmas because like obviously we're away from family. But I got to be in Ohio for about 2 weeks, so I got to
Yeah,
see everybody. Yeah.
it was nice to have you back. We actually tried to do a podcast over that period of time, but you're right. The equipment was it was not in the cards for that to happen. But I had a nice. So I'm back from Christmas, and this is one of my first times seeing you since I've been back, and came out of a meeting that was a challenging meeting, and I arrive here on video, and the first thing you say to me is, "Hey, your stomach's looking a little bit larger."
Yeah, just a little bubbly. But I mean, it's post Christmas, so it's understandable.
People say
You're
that
you're
I'm a
bailing
giant.
on your yeah, you're bailing on your weight cut.
Yeah.
Yeah.
So what are we going to talk about today?
You want to talk about New Year's resolutions, right?
We can start there. That's a good place to start. I mean,
Sure.
we probably won't have one before that. And I was just kind of interested to see if you had something that you had pre-thought out that you wanted to accomplish in 2023, or much of the same.
I I mean, I forget what my resolutions were last year. I think one of them was bench 225, and I can do that for reps now, so I
Nice.
got that one. But it might not have been. I
Check.
don't even know. For some reason, I felt like that was one last year. I mean, I always do like a weightlifting type goal, physical activity type goal, a professional goal, and then it's always read more. It's always my resolution, which is like not a very good goal to set because it's like ill-defined. But I'm trying to start to get into actually reading physical books rather than audiobooks. And
Mhm.
I've been doing pretty good recently in the past couple weeks.
Yeah. Now there's something to that. I do a little bit of both. I do the audiobooks as well. But I was looking for me, it's a little bit more of the same, but if I guess I could put like a word on it, it would be laser focus. What I mean by that is whether you're an investor or you're a business owner or whatever there is, or if you're just a regular person who has a job, right? There is an unlimited amount of distractions out there. Whether that is the shouting on social media, whether that is your distrust with government bodies, whether that is the news that's out there. There's a lot of stuff that would throw you, of course. And this would be uh, this year of 2022 is a perfect example of that on the investing world, right? Because we had a decade long of essentially bull market, and propped up by cheap money. We've talked about that before, but we've had a year here where a lot of asset classes have been down. Not only stocks, right? We've got real estate that has down. Bonds have faced their challenges as well. And it's easy to get caught up in the moment, right? We are going into now 12 months of essentially a bear market. And it's easy to think that either that's the way things are always going to be and shift your mentality, your way of investing to something that is more outside what you had been doing successfully over the past 10 years. And the opposite is true when we're going through that bull market, right? We always think, hey, the good times are always going to last. What's that quote? This too shall pass, right? Whether it's good
Mhm.
times or bad times, this too shall pass. The key to being a successful investor, we've talked about this countless times, is not freaking out when we have these bear markets, because they're going to happen, right? And act accordingly, because the way that we act in these bear markets largely determine our long-term success. So I guess if I was going to say what my goals are for 2023, it's much of the same. I've got some personal goals. I've got some, like you, I've got some business goals, but I want to help drown out, put blinders on to some of these distractions that, if you're not careful, you allow yourself to follow and fall in a trap to things that you can't control.
Yeah. Yeah, the things that you can't control is a difficult one because it seems like that stuff is so important, especially like on the political level. Like people put so much of their time, energy, mental like bandwidth towards like politics. And at the end of the day, you have effectively 0% chance of impacting any of that stuff. But it does feel like it's so important. So, and then you don't want to be like apathetic to everything where you're just like, the government can just go on unchecked and because I can't fix anything. So it's like a tightrope that you kind of have to walk to so that it doesn't consume all your bandwidth, but at the same time, like still be concerned about some of that stuff.
One more concept that I'm going to try to improve on too is this idea that events are neither good or bad, right? We tend, as people, we tend to put a label on it. Events are good or bad. An individual gets in a car crash and breaks their leg. They go to the hospital. They're there for a couple weeks. Somebody, what are you laughing at?
I'm just waiting to hear if you're about to spin this as good news.
It's good news. It's good news.
Okay.
So the people's family come to visit him and their friends, and they say, "I'm so sorry this happened to you. What bad luck that you had." Meanwhile, a mudslide lets loose on the hill where his house is at, wipes out his house, buries the house 20 feet under the ground. And so you would look at that situation as that accident that he had in the car was neither good or bad, right? He could take it for what it is. You could look at it as it was good. It saved his life. But I think if you look at the market, or if we're looking at events in life, how much of it are things that we just put labels on, and then we give it's a good or bad, and as a result, we let it affect our day, or we let it affect our year, right?
Mhm.
I'll hear people say, "This was a bad year." How was it a bad year? Is your family still around? Are you still breathing? Do you still have a job? I mean, how bad could it be?
Right. I had the same thought process about I mean, this is just strictly speaking about my own personal experience, but during 2020, that was a really bad year for a lot of people. But like personally, I pretty close to graduating college. There's a lot of really good stuff, and I tried to like keep that in check. Like as people were making those types of comments, like, "Oh, it was a bad year, it's a bad year," and like having those conversations to be like, "Was it a bad year?" Because like of the news and like everything, but like personally, there's a lot of things you could look at in your own life and realize that it was actually a pretty positive year. And at the same time, you can feel bad for people that did have a horrible year. Maybe they lost somebody in the pandemic, but yeah, just kind of framing that and keeping everything in perspective. Like there's always a positive, even if, I mean, I don't think it's selfish, but I mean, something like that, like look at the good things in your life is basically what I'm trying to say.
Yeah. Good
Count your
things don't happen to
blessings.
people. Bad things don't happen to people. Things just happen. Jocko Willink, who both you and I follow, has that motivational video out there that is called Good.
Yeah.
It's good. And it kind of follows the Ryan Holiday book on the obstacle is the way, in the sense of training your mind to see these potential roadblocks, these setbacks in life as essentially strengthening tools that allow us to accomplish our ultimate goal. And that's really what, from the investing world, if you look at 2022, I believe that's ultimately what we're going to see in this, in the sense that, if we could fast forward 3 years out from now, where some of these asset prices are been, so reduced. We're talking earlier, is Tesla a buy right now? Tesla's been hammered. You can buy Google for a fraction of the price. You can buy Amazon for a fraction of the price. And I'm not saying you go out and buy those, but these are companies that I believe still have, wonderful times ahead of them as far as revenue generating. And if we're taking a long-term view to that, you might ask, can I go through a 2022 again? When do I get a chance to buy these assets at reduced prices?
Here you go. Here's a way to frame this as a positive. The amount of people that are spending six figures on pictures of monkeys has gone way down. That is a good
It's
thing.
true.
I think, I think all these meme stocks, meme coins, NFTs that have been propped up by cheap and easy money, I think it's good for the crypto, I'll say crypto ecosystem, if a lot of the junk gets wiped out. And I think you could, I mean, we've talked about this before, but it's getting to the point now where all of this perceived value on some of these other crypto projects, it only sounds good when the money's flowing, when the cheap money's flowing through the system. But when things get tough, like it kind of puts in reality, like which of these projects have actual utility and which of them are not useful in the most charitable term, and then straight up scams in the more negative term.
Yeah.
In the more realistic term for some of them, like you look at FTX, Terra Luna, like there's been so many crypto scams that have been exposed this year.
Yeah, for sure. And that's a space where, at least now, I don't feel like there's room for a ton of winners. There's got to be a champion that leads that. And you and I feel that eventually will be Bitcoin. Who knows if it will be? But you can't. Lynn Alden put out a newsletter a couple of weeks ago, or maybe it was a week ago. And one of the things that I noticed in that newsletter is she was talking about these developing countries. And for example, she took Egypt. And Egypt, roughly 67% of the workers in Egypt are unbanked. They don't have a bank account.
Mhm.
So they're going out there and they're toiling and they're working. they're getting paid in cash, and they're storing that cash inside their house, under their mattress, wherever that might be, unable to earn interest on it, eroding from the effects of inflation, victims of theft, victims of my house burnt down, I lost my life savings. And not only that, if they were to go out and spend that money outside of Egypt, right? Who's going to take that money? It just doesn't
Right.
exchange rate on that. Nobody wants that money. So they get hammered. They're at a financial disadvantage. And I don't know if the answer is Bitcoin, Dirk, but there's a problem that needs to be solved for these people. And potentially a sound crypto could be one of them, right? Because a Bitcoin would spend the same in the United States as it would in Egypt, as it would in Nigeria.
So the broader context of that of that article was a tweet that she posted where she said, you sell your house and you don't need the money for 10 years. Where do you put the money? And then she kind of like noticed immediately the kind of like first world perspective. Like people in the first world, the developed world, don't even realize that that is an issue. They're like,
Sure.
I'll just keep it in US dollars. I'll just keep it in British pounds. I'll keep it in euros. Even in like China. But if you're in Egypt, if you're in there's been several bouts of hyperinflation this year. I know Turkey was one of them. Maybe Lebanon was another one.
Argentina's had some problems.
Argentina, yeah, Venezuela, those are good examples. So what do you do? Literally, you don't have access to dollars because they're not part of the SWIFT banking system. It's really hard to get currency conversions. You can't keep it in real estate because if you live under authoritarian regime, they could just take the property at any
Yeah.
like very easily with the SWIFT or with a pen stroke. Gold, you have theft risk. If you have to leave the country, they're not going to let you leave with gold. It's easier to like locate. If you have, let's say you have $5 million in gold, that's become physically impossible to actually deal with that. A potential solution would be something like Bitcoin, but you have volatility associated with it, and even more so, maybe like a US dollar backed stable coin. But the problem with that is the issuers have been proven to be somewhat shaky. They're shady to say the least. Like there isn't transparency and regulation in the space. So that's kind of like the thought experiment that she was running in that article. And I thought she made some really good points for and against Bitcoin, for and against all the other alternatives. But it's pretty clear that a lot of the traditional alternatives that people in the first world would think of don't work in the developing world. Like real estate would be a good example that a lot of people in the United States would think of because you could buy real estate. Pick any metropolitan area, maybe outside of like Detroit and Cleveland or something like that. But pretty much any metropolitan area, and it's pretty consistent that it's going to appreciate in value because people want to live there. And you don't really have the risk of the government coming in and seizing it. You could keep it in cash because our currency is pretty stable. Even in the UK, they've had in Europe in general, they've had higher inflation than the United States has. But for the most part, the currency is pretty stable. So I think it's an interesting discussion. And when you're talking about these issues, it's important to put them in the global perspective.
Yeah, absolutely. Yeah, definitely. So people have asked me, is Bitcoin going away because of this? I don't know if Bitcoin's going away. We'll see if it's here in 5 years, 10 years. If I had to venture a bet, I would say yes, because I think it has the most potential of all the cryptos because of the governance of it, as far as the way it's set up, that it potentially lends for solving at least some of those problems.
Yeah, I think that that's a funny story. I wanted to bring this up on the podcast. So I was home for the holidays, and my grandparents came over. And they were talking. They watched the news a lot, and my grandpa and my grandma both asked me independently, like, "You didn't invest in the Bitcoin stuff, did you?" And my grandpa asked, "Yeah,
Bitcoin.
my grandpa goes, you didn't invest in any of that Bitcoin bullshit, did you?" So I was literally laughing. Like my mom and my dad both know that I invest in crypto, and like I annoy them with this stuff as well. So they saw me, or they were laughing along with me because they knew that I invested. But that's not exactly the environment where you would give them the whole pitch of like what makes Bitcoin different from FTX or FTT token or whatever. But
right.
it was funny, and I did want to bring that up on the podcast.
The Ponzi schemes that have happened this year and 2022 have definitely set the crypto world back a
Yeah, we've
long
talked
time.
about this. We've talked about this a lot, like outside of the podcast, where um like it seemed like last year and the year before that, it was the constant buzz about the institutional adoption of crypto. You saw like money managers like Fidelity, which I mean they claim to still be gung ho on Bitcoin still, but I mean hedge funds, uh, the BlackRocks, Vanguards of the world, the likelihood that they're going to allocate to any of this stuff. Um, but yeah, in 2020, 2021, it was this constant thing of like, oh, they just need regulation, and then they're going to put 5% allocation into Bitcoin, and then Bitcoin's going to go to $200,000 a coin. I think that with all the FTX stuff, that pushed it back. Nobody's going to even think about touching this stuff until you get clear defined regulation, and also people test the waters out before they would test the waters out themselves. Nobody's going to be the first mover because it's because the regulation is so young and it's going to be developing as it gets rolled out. So nobody's going to take a chance. Like look at BlockFi. So BlockFi offered this product. They were going on making money, having a successful business, and then New Jersey, there's like a court in New Jersey that was like, no, this is an unregistered security, and we're going to slap you with $100 million fine. Like it has to be extremely clear and laid out before anyone's going to put some serious money behind it. And I think
Yeah.
the FTX thing just set it back. Yeah, possibly like years.
Yeah, for sure. Because to your point with your grandparents, right? They are not probably they haven't spent a whole lot of time understanding how Bitcoin works, right? And the merits of Bitcoin, the
And
pros
what
and
makes it
cons.
different? Yeah.
Yeah. So they've lumped it all into one and they all consider it to be phony money. And maybe it is. We'll see.
Yeah, we'll see.
I wanted to talk today about the interesting topic on yield to maturity. And this is a timely talk because in the past couple of weeks, you and I have kind of thrown around the idea, is now the time to invest in fixed income? If you look at long duration treasuries, the TLT 20 plus year treasuries, down about 30% for the year. If you look at the Vanguard total bond market, which is an intermediate, that's down substantially as well. I mean, this was the first year, correct me if I'm wrong, Derek, this was the first year that I can remember where long duration treasuries performed worse than growth stocks.
Yeah, I don't have the back test on that, but I would imagine it would be, if it's not the worst year, it's probably top 5, top 10, top 10 years. Yeah.
Yeah. And as a general rule, we do not want to own bonds, or I should say, let's get some definitions out there. So when I'm buying a bond, what is a bond? Bond is essentially debt. I'm buying debt. I'm buying somebody else's debt. And in return for that debt, the issuer of that bond is willing to pay me interest during the time that I hold that. And so when you'll see a bond, they are offered in these durations. So it could be 1 year, a 2 year, a 5 year. And that's essentially how long they're going to make payment on this until the bond reaches maturity. And when the bond reaches maturity, assuming that the issuer of the bond is still around, they give you your money back, right? So that's why a lot of times with bonds, they pay attention to the credit worthiness of the issuer. If I am getting a government bond, if the United States is issuing a bond, that's considered much safer than a corporation who's issuing the bond, because the government has the ability to tax and print money to make good on those bonds. So we've gone through this before, but I kind of wanted to lay down some groundwork into that. And so they pay attention to the credit worthiness, and you might see a bond that is AA or single A or BBB. If S&P is a body out there that rates the credit worthiness of these bonds, Moody's does it as well, but S&P uses a BBB, AAA, single A. Anything that is BBB or higher is considered an investment grade bond. So if I look at the Vanguard total bond market, which is, as I said, a intermediate, it's one of the largest bond ETFs out there that you can buy, for sure. That Vanguard ETF, bond ETF, has over 17,000 holdings in it. So 17,000 individual bonds. And the average duration of that bond is 6.5 years. And that would, again, fall in the intermediate class. And what does that mean as far as intermediate? Well, the length, if I'm willing to lock my money up for a period of time, I would expect to get a higher rate of return than if I'm locking my money up for a shorter period of time. And you have talked in the past about the yield curve and what happens when it inverts, and that's not true, where the shorter is getting paid more than the longer. That's a bad sign for the economy.
The
Not
way
gonna go in-
just a real quick thing. This is kind of how because I've said this example to people before, like about the question of why longer duration debt has higher rate of return. Think about like, so I loan you $100. What are the odds that you're going to have $100 next year? Like, I know that you have a job, you have assets, like it's very likely that you're going to pay me back. But if I say 40 years in the future, well, it's like, I don't know, the world might not, or Earth might not be
Right.
here. The United States government might have a civil war or whatever. Like, you can think about like 40 years in the future, like things are going to be dramatically different and you can't predict them. So you have to be compensated for that uncertainty. Sorry,
Yeah.
just a quick tangent.
No, that's a perfect example. So the longer duration, obviously there's more risk involved with longer duration. And really what the risk is, there's a couple risks. There's risk of default, meaning that the issuer of the bond is no longer around, to your point. There is interest rate risk, and that is interest rates affect the value of bonds. So if I go out there and I buy a bond, I buy $1,000 bond, and interest rates go up over the next 6 months, and a new investor can buy, a similar bond as mine that now pays a higher interest rate. Well, then all of a sudden, if I want to sell my bond, I have to sell it for less, because who's going to pay full price for it?
Right.
And so, and conversely, if interest rates were to fall, my old bond becomes more valuable, because if I want to sell that, the buyer of my bond can now get a higher interest rate than what they could have if they bought a new bond. So interest rate risk is a real risk to fixed income. And that's really what we pay attention to when we're managing accounts. We're paying attention to the creditworthiness of what we're investing in. We're also paying attention to the effects of interest rates. And so why are we kicking around the idea of investing in fixed income again? We'll see if we actually do. But why are we kicking that around right now, when you and I both believe we probably have a couple more interest rate hikes ahead of us? And if that were the case, you would think that would drive the current bonds lower. So why would we buy it now? Well, there's a couple thoughts into that. And one is, maybe bonds have priced those in already. That was a conclusion that we came to earlier on in the year, and that wasn't true, right? Because they started jacking up the interest rates at 75 basis points, and they did it consecutive times. And obviously the bond market was telling you, no, we have not priced these in yet, because bonds continue to lose value. But I'm going to look at two bond ETFs, the Vanguard Total Bond Market, BND, and then also the iShares 20+ year treasuries, ticker symbol TLT. If you were to get on Yahoo Finance or Morningstar or Google Stocks or wherever you go to get your stock information, and you typed in BND, it would pop up and it would tell you that the annual yield on that is 2.4%. But that is not necessarily the whole story. As an investor, I'm more interested in the yield to maturity. What I mean by that is based on where the bond's value is now to maturity, what is it going to pay me? Because remember, for all of 2022, interest rates have been rising, which have been forcing the price of bonds down. So if I look at, I mentioned that the Vanguard Total Bond Market has over 17,000 bonds in that. The average credit rating of those bonds is AAA, so investment grade bonds. The average duration is 6.5 years, but the average yield to maturity is 4.51%. So basically, why is that? Because I'm essentially buying these bonds, these collection of bonds, I'm buying them at a discount to their par value, meaning that they have lost value. They're still paying their contractual yield that they had, but because I'm able to buy them at a discount, my yield to maturity is actually more would have gotten into that when they purchased them right when the bonds were issued. And so if we look at the longer duration treasuries, similar story. If I were to punch TLT into Morningstar, it would say that it's got a yield of 2.44%, 12-month yield, but the yield to maturity is actually 3.95%. And in addition to that, the iShares long duration treasuries have fallen about 30% for the year. So you could get a juicy yield potential, and there's a potential for an increase in the par value of the bonds that are in that ETF as well. So that's kind of what we're looking at here. Is now the time to pull the trigger, or do we wait for the all clear sign when interest rates have paused?
Yeah, it's a tough one because the Fed historically has been really awful at predicting the ends or beginnings of the hiking cycles. We were just talking about before we hopped on the podcast. At the beginning of the year, Jerome Powell was doing, or no, the Federal Reserve was doing quantitative easing into like 5% inflation. I forget where inflation was at the beginning of the year, but and then also he at that point he said he wasn't even thinking about raising rates until 2024, and then now we're at we're at like 4% Fed funds rate, at the fastest rate in history of the Federal Reserve. Like we've never gone from on a rate of change basis, we've never moved faster in a hiking cycle than we have this year. Just the juxtaposition of those two things, not hiking until 2024 to the fastest hiking cycle in the history of the Fed. So they're horrible at predicting stuff. But as they have it now, they are predicting that the terminal Fed funds rate, meaning the Fed funds rate at the end of this current hiking cycle, will be at 5%. If they put out the dot plot, the Federal Reserve dot plot, that basically every member of the FOMC votes on where they see rates on certain time intervals. And the consensus for 2023 is they will peak out at about 5%. So, and that's about what markets are pricing in as well. So you could make an argument that all of the future rate hikes are priced in, at least for this hiking cycle. But then you run into the risk of, when we get to 5%, is inflation going to stagnate, or is the progress on inflation going to stagnate? Where we got from 9 to 7 at a really impressive clip, never broken down this fast without a recession in history since they started tracking CPI. So a historic breakdown in inflation. And by most metrics, we are not in a recession. We could argue about whether we will be in a recession, but as we now speak, inflation broke down without a recession. So what happens when we get inflation down to 4% year over year, and the Fed funds rate is at 5%? Does it continue to trek down towards 2%, which the Fed has said we're not going to break, like 2% is the target, we're not revising the target, or does it get to 4% and continue to trickle down to 2%? Those two things will determine whether they have to do more hiking or not. So it's an interesting discussion, because I mean, you look at what we had to do in the 1970s to get inflation down. They had to raise interest rates to double digits, which I mean isn't really feasible with the amount of debt that we have on the books. But I think on a risk adjusted basis, I don't think it's the worst idea to maybe dip your toe in. I mean, do your own research and stuff. That's definitely not investment advice. I currently don't hold any bond ETFs or anything. That's not something that I'm investing in. But you at least can make an argument as why you would do that.
Yeah. I mean, we've talked about this in the past. You want to get away from talking about asset classes as safe or risky, right? Mm-hmm. Their names by themselves don't make them safe or risky. Their valuations make them safe or risky. And bonds have been beaten up. You know you're going to get the yield out of them. So, I don't know. Are we at a point where we can call a bottom? I don't think so, especially with a couple more rate hikes ahead, but we'll see if that's the case or not. So
here's a question. We always talk about the debt clock, that website. I think it's like usdebtclock.org or something like that. Hold on, I can get the actual name of it. So yeah, usdebtclock.org. You can see the national debt. You can see the deficits that we're running. You can see the unfunded liabilities, which is basically like so presumably Social Security is planning on being paid for the foreseeable future. There's not going to be a stop to Social Security. So that's money that we have to come up with that's already earmarked. Like, so for the income that we bring in, half of that money is already spent. More than half, probably closer to like 70-80% is already spent on liabilities. So do you feel comfortable putting sizable capital into a long-term treasury, knowing the dynamics of the debt and how much debt we have and the deficits that we're running?
I'm not an expert on the fiscal policies of government in the sense of, the long-term health of, obviously, from a layman's terms, looking at that clock would tell you we're in some trouble, right? We got to make some hard choices, and it appears like we got some pain ahead of us. If you're talking about You know, you can travel down rabbit holes about the Great Reset or different ways in which we deal with this. But the reality is, I would answer the question no, and not because of that, because I'm not a predictor on what happens with the health of our government and the U.S. dollar and Treasury bonds. But just long duration treasuries treasuries in general have not been a great investment. You know, when we look at an inflation adjusted return, especially if you're holding these outside of an IRA, I'm going to get taxed on them. Inflation has typically beat up on these things. And yes, now we have a situation where maybe these, you know, treasuries in the past have been considered essentially equal to gold, right? If foreign countries have invested in treasuries because the dollar was the global reserve currency and they were considered as good as gold. They're a little bit shaky now, right? I'm not saying that you don't go invest in them, but
there's at least more risk than there was.
Yeah. And I think for the first time you're looking at that and just asking yourself the question that you just asked me: is this something that I would be comfortable with locking my money up for 20 years? I'll tell you, Dirk, there's not much that I would be comfortable with locking my money up for 20 years and saying, yeah, I'm never going to change.
Going back to our previous discussion, you know?
Yes. I mean, things change, right? I need to be agile. I need to be able to move into asset classes as they come and go. I'm not saying that we're jumping ship, but I mean, you have to take the data as it is. We just talked when we opened up this podcast. Things are neither good or bad. They just are. And so we have to react to that.
I think that if you look at a historical perspective, this isn't the first time a country has gone off a sound money standard and they've gone up over 100% debt to GDP. And what usually happens is why would you voluntarily default on the debt? That's what you're doing. You're voluntarily defaulting on the debt because you can print the money. Like you can just print more money to pay down the debt, pay the interest, pay the principals off. But usually what the release valve is the currency. So I think a bigger risk is we run into I'm not going to predict like a hyperinflationary event in the United States, but just structurally higher inflation than what we've grown accustomed to. Like that 2% target, if we look a decade into the future, I think there's a real possibility that we are not running at 2% structural inflation. It's probably going to be a lot higher than that because they have to print more money to service the debt.
Well, that actually is what came to mind when you said, let's assume that they pause interest rates because inflation year over year gets to 4%, and then it stagnates from there. Well, if I have a money market that's paying 5 or 5.5%, am I okay with 4% inflation? And that's a question that we as a country are going to have to answer.
Yeah. The only problem with that is that it does break the calculations and the models for fixed income investors. The fixed income market's much bigger than the equity market. Yeah. And you get sovereign wealth funds, like serious money, like the money that moves the world is backed or is backing the fixed income market. And part of the model of why you would invest in fixed income is structural 2% inflation, because you're like, okay, I can get a 3% coupon. Long term, we'll have 2% inflation. But if it structurally changes so that it's 3%, all those bond investors are going to have to dramatically reprice what they would pay for a fixed income instrument, what they would pay for U.S. Treasuries. So you could see a dramatic repricing in yields, which would cause the bond values to fall. So and then if there's like leverage in the system, because fixed income is seen as like a really safe investment. So you would feel comfortable if you can secure debt cheaper than the coupons you're receiving, you could theoretically lever that up to infinity, because you're basically making a bet that the United States government will be here in 10 years. A lot of people would make that bet. But if the underlying asset backing this leverage is the bonds, and the bonds significantly fall in value, that could cause some systemic risk. So I think that's why the Fed is so serious about not letting inflation become structurally entrenched and getting it back to 2%, is because there will be a dramatic repricing in fixed income.
Yeah. Good stuff, Derek. That's information here that I think probably not the average investor knows about.
Cool.
Well, Derek, I got to run. Quick question. How close do you pay attention to the stars on Amazon? Like when 5 stars, 4 stars, 3 stars?
Pretty closely. Like if there's one that's 3, one that's 5, I'll get the 5-star one.
So we can, because we're doing video today, I can actually show this. But I came across, my daughter is into tea, different types of tea. And I came across this stuff It's called mugwort. And mugwort can be ground up and used as a tea, and it apparently is good for you for stress relief and things like that. But this guy who purchased it sent a picture of the product, and he gave it 4 stars. And he said, "Oh, by the way, in the product here, I found stones, some metallic pieces, and items that I can't yet identify." And he gave it 4 stars. So I'm curious, what had to happen to this guy in order to get a 3-star review?
Yeah, right. Yeah, right. Seriously. It's like, but the rest of it was great.
Right?
Yeah.
Well, all right, Derek, good stuff. Where can they find us on social media?
As always, thanks everybody for listening to Dynamic Growth. If you like the podcast, like, share, subscribe wherever you get your podcasts. Follow us on Facebook, LinkedIn, Instagram, and we're back on YouTube. Subscribe at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we'll see you guys next week.
Okay. Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Florida, and Texas. At any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific investments. Do not take that as a signal to buy or sell them. Do your own homework. Make sure they are suitable for you. Not all investments are suitable for all people. Keep in mind that investing involves risk, including the potential loss of principal.